The Reserve Bank's Monetary Policy Committee meets next week in the best of backdrops. Growth is higher than expected, inflation is lower than expected. So, what should the MPC do? As always, CNBC-TV18 Citizens MPC meets to deliberate on the issues that are before the RBI and what should be done with rates and with the monetary policy stance. I have with me Chairman Pranab Sen and members of the committee, Samiran Chakrabarti of Citi, Shaumikanti Ghosh of State Bank of India, Sajid Chinoy of JP Morgan and Sonal Verma of Nomura. Just for your information, let me tell you, Sonal Verma is joining from Singapore and Sajid Chinoy is joining actually from San Francisco. So it's actually a global discussion that we are having today. Gentlemen and Sonal, thank you very much indeed for joining me. Samiran, let me start with you. And, you know, GDP is top of the mind. So I must first ask you that. What elements from the GDP will impact monetary policy making at all?
So, Lata, as you rightly mentioned, that it's kind of a Goldilocks situation for RBI, good growth, lower inflation. But sometimes the higher growth number also worries the central bank that it could lead to inflationary pressures going forward. But this is one of those situations where there is good news even there. If you look at the structure, the composition of the growth, it's more towards the investment side of the economy, and consumption is actually a little weaker.
Yes.
So maybe this will not translate into any immediate pricing power issues and inflation issues, core inflation issues. So to that extent, I think RBI would be quite happy with the growth number. In fact, we would not be surprised if there is a marginal upward revision to their own growth forecast for FY24 from the 6.5 that they have currently.
Oh, okay. Now that's very important. If they're going to if they revise it even upward, extremely positive. Okay. Of course, the big worry for the MPC is always inflation, and that's not a worry at this point in time. So, Sonal Verma, on that, do you think the inflation trajectory may have to be redrawn for the same reason that Samiran is saying? You know, growth is very strong. So will there be any rethink on the inflation trajectory? And, you know, if it is not, is there a chance of a cut then?
Right, Lata, I think so. First thing on inflation, there is actually a need to redraw the inflation trajectory, but on the downside, not on the upside. The higher growth, as Samiran mentioned, is not leading to inflationary pressures at all. In fact, in Q1 FY24, average inflation should be nearly 60 basis points below the RBI's projection of 5.1. So we already have data in hand that suggests that the year is starting out on the softer side. And if you look at the forward-looking path for inflation, I think the biggest uncertainty right now is on El Nino and what it means for food outlook. But as far as the input cost pressures are concerned, with respect to cost pressures on food are coming down, the input cost pressures for manufacturing are coming down, which is yet to reflect in core goods inflation. And services actually have not really seen a massive increase as was feared. So just on the basis of lower Q1 and moderating input costs, we do think there's actually a case for a downward revision. So compared to the 5.2, at the margin, it should be brought down by maybe about 10 basis points, just to align it to lower Q1. Whether the RBI does that or not, given uncertainty on El Nino, is another issue. But we don't really see upside to RBI's 5.2. I think at the margin, the risk to inflation is actually it'll end up being lower than 5.
Okay, that'll be a great monetary policy if the Reserve Bank, two headlines that come out are growth revised higher and inflation revised lower. And if I'm not mistaken, Samiran, you've already revised it lower to 4.9. For the current year, the Reserve Bank itself stands at 5.2. Okay, then the other big thing is the global backdrop. Sajid, since you are away from India, maybe your best place to parse the global takeaways. For the Reserve Bank, there were rate cut expectations building up in the last 3 or 4 weeks. Apart from the debt ceiling drama, the expectations of rate cut are actually coming down, especially after the FOMC minutes. So your take, What should the Reserve Bank worry about on the global scenario? Rate differentials, is that a worry?
Lata, for the last 12 months, analysts and economists have been in this recession frenzy and worried about an imminent global recession. Every 6 months, economists say the recession is coming in 6 months, but the data has consistently gone in the other direction. Remember, the first quarter of 2024 was going to be the quarter that many economists had predicted there'd be a U.S. recession, and the global economy would stumble because of that. Guess what growth in the first quarter is? It's tracking above 4% globally, right? Much above trend. Now, of course, some of this is the China reopening, but even if you take the China reopening out, both developed markets and advanced economies have actually accelerated going into 2024 in the first quarter. So growth is much stronger than had been anticipated. Second quarter is slowing to about 2% to 2.5%, which is close to trend growth. Why is this happening? Why are we getting consistently surprised on the upside? Because everybody's focusing on one shock, which is the monetary tightening and the 500 basis points of rate increases by the Fed and the 350 basis points of increases in Europe, and the fact that that's going to cause a slowdown. But there are other things going on at the same time. Many of the adverse supply shocks from COVID, from the war, are reversing, and that's helping inflation and helping growth. Global inflation was tracking 9% on a sequential annualized basis in the first half of 2022. It's now tracking 3%. And what lower headline food and fuel inflation does is increase purchasing power for households and boost consumption around the world. So the first point I want to make is global growth is holding up much stronger than we had expected. Now, this is not, however, a soft landing story, because the bad news is that advanced economy core inflation seems to have gotten stuck at close to 5%, right? And so that, in a way, the fact that inflation is so sticky globally, core inflation is sticky, not headline, is sowing the seeds for a recession at some point in the future, because monetary conditions will have to remain tight. But the point is, there is no imminent recession. Now, this has two implications for India. The first is the worries that we had about global headwinds is clearly lower. I think what's sometimes forgotten is that much of the upside surprise that happened in the GDP print 2 days ago was because of stronger exports. If you look at the NSO's implicit export number for the first quarter back in February, it was 4% growth in exports. The actual turnout was 12%. So much of the upside surprise between 5 and 6% growth can be explained by stronger exports. So that's the good news, that the global economy, at least in the near term, will not be as much of a source of pressure on India's growth as we had worried a year ago. The worrying part is that advanced economy central banks may not be able to stop just as yet. The Fed may pause in June, but if the data continues to remain as strong as it is, markets are now pricing in some rate action by the Fed in July. And so to the extent that these rate hiking cycles around the world go on much further than we had thought, that constrains the ability of emerging market central banks, including the RBI, to ease anytime soon.
Okay, got that. The present is brilliant, but the future is cloudy and therefore data dependent. Soumya, the most important thing is liquidity. I mean, we were almost getting into negative liquidity, deficient liquidity in the interbank system. Banks were going and borrowing from RBI repo. Suddenly now this 2,000 rupee note or whatever, there has been a deluge of liquidity. So how do you tie that in? Does it mean the stance remains removal of accommodation? And anyway, anything more that they should ponder over liquidity?
Yeah, thanks, Lata. I think as Sajid was mentioning, the uncertainty part actually has taken the center stage, and it's evident everywhere in terms of the data. Even in the liquidity today, I think liquidity was a constraint at the beginning of the year. However, liquidity has now improved much better than the earlier, what it was in April, perhaps due to two reasons. The first thing, obviously, as you said, the withdrawal of the rupees 2,000 rupee notes, and the initial trend suggests that a large part of that is actually going into deposits. Of course, this data could change, but even if you do one simple maths, that could have a bulge in the deposits, which could have a bulge in the liquidity, which could be in excess of rupees 1 trillion. That is the initial trends, but that is actually a favorable one. So the second point is that I think in the last 2 months, the total portfolio capital inflows has been in excess of 7 billion.
Yes.
So this is actually has been a massive number, and markets are actually climbing a high every day, even if we speak today. So in that context, I think the central bank is also has to ensure that that liquidity which is coming into the system is properly absorbed. So there are 2 points. One is the withdrawal of the 2,000 rupee notes, which could lead to an additional bulge in deposits. The second point is the purchase of dollars from the market. So there the central bank will have to take a call whether it wants to add to foreign exchange reserves or it wants to let the rupee find its own course. That's a debate which I can do separately. But my sense is that I think the central bank, as of now, will be best placed to continue with the current stance which has adopted, because at this point of time there is no point in getting into a situation whereby you move into a neutral mode, because things can change pretty fast at some point of time. So my sense is that it continues with the withdrawal of accommodation, given that these two favorable uncertainties has come into the picture.
Okay. Well, both those we will debate. The fact that exports and what should the rupee do. There was one big exporter who told me that he owes his excellent performance solely to the management of the rupee. He wants an appreciated rupee. So there could be that part. In any case, that issue later. Dr. Sen, what I wanted to ask you is, growth is doing well and inflation is falling. As Samiran has already put out a paper, he's cut the inflation forecast for the current year to 4.9. I think Sonal is also hinting at that. When do central banks cut? Do they cut when inflation is falling, or do they cut only when growth is in danger?
Well, as far as when they cut is a judgment call. If inflation falling is no reason to cut. It's only if inflation is falling at a rate where you are in danger of going into a deflation, then a cut becomes justified. But the growth argument, weak growth always supports a rate cut.
Okay.
Now, at the moment, there are no signs of weak growth happening. And inflation is unlikely to go into deflationary territory. I mean, however much the inflationary trend moves downwards, it's not going to go down very much below 5%. So I don't think there is any great reason why rate cuts should be resorted to at this point in time, indeed not in the immediate future either. So I think that one should simply put off the table. The real question, I think, Lata, is the nature of growth what we would like it to be? As I think Shamiran pointed out, it is heavily skewed towards investments. Now, when you have a growth rate of 6.1% and consumption is growing only at 3.8%, you really should start worrying.
Oh.
Ideally, what one would like is with a 6.1% GDP growth, consumption should be growing at somewhere around 5.5%. So this weakness in consumption is something we need to worry about. Okay. Now, here comes the whole issue, which is that although systemic liquidity has improved significantly, but the likelihood is that currency in circulation would have gone down.
Yes.
And that would hit essentially precisely those components of our overall consumption demand, which are the most vulnerable.
Okay.
And that is something, so this is not something for the MPC to worry about. But I think it's certainly something that RBI should be worrying.
Okay, that's really taking the discussion to a very interesting point, sir, because in some parts of the debt market, a cut was priced in around December, thereabouts, and that's why I brought it up. Thank you very much. Now, we have to take a break for Bazaar viewers, but viewers, the entire show will be presented to you at the end of the after market hours, and the big mystery on how the MPC will vote, you will know after market hours. For the moment, a break and Chartbusters for you Bazaar guys.